Hello, I'm David Johnson, founder and managing partner of Abraxas Group, and I'm here today to share our guide for executives in working with private equity. For executives new to the experience, the transition to working with a private equity-owned company can be a jarring but very rewarding one, especially for those looking for a challenge. Too many executives make the leap to a private equity-backed company without first gaining a full understanding of the differences in mindset, pace, and structure that come with private equity ownership. Taking the time to understand the manner in which private equity investors assess opportunities and measure success is crucial for building a positive working relationship. Private equity firms will typically look to have a hold time of 3 to 7 years. Some firms will remain invested in a portfolio company for 10 years or more. Hold times will vary by firm and situation. Private equity firms traditionally have raised investment funds, usually with a 10-year duration. The senior private equity professionals are general partners of the fund, making the investment decisions. The limited partners, known as LPs, are generally endowments, pension funds, family offices, sovereign wealth funds, and other institutional capital sources. From its early manifestations in the 1960s through a formalization in the 70s and 80s, private equity has sought to optimize the capital structures of portfolio companies with more debt than would be common outside of a private equity context. The implications of this approach can be profound for executives, as the capacity to generate outsized equity returns is increased, while the risk of bankruptcy also increases. Navigating the demands and limitations of a more highly levered capital structure is one challenge that executives new to a private equity environment often underestimate. Debt covenants, which set the requirements a borrower agrees to as a condition of borrowing, require constant attention at many private equity-backed companies, especially those that have recently experienced challenges. Anticipating any failure in covenant compliance in advance is crucial for managing lender relationships. Executives who are successful in a private equity-backed company are those who possess and are quick to emphasize certain key characteristics. Leaders able to inspire, delegate, and drive performance. Those who are accountable. Leaders who are high energy and action-oriented. Those who are data-driven. And those who are forthcoming regarding challenges and setbacks have the opportunity to be successful. The traits of unsuccessful executives are those who focus on management and not leadership, those unable to inspire a team to action, those who are uncomfortable with accountability, leaders who adopt a wait-and-see approach and are slow to act, those who manage by rule of thumb, and those unwilling to acknowledge challenges and setbacks. Executives looking to make the jump to a private equity-owned company should assess not only the company, but the private equity firm. Take the time to understand the private equity firm's investment thesis, its timeline and general philosophy. A successful partnership between a private equity firm and an executive team can yield incredible results, but there must be alignment. Key takeaways. Emerging structures. The structure of private equity is changing as the variations on the classical private equity model proliferate. Leverage. A more heavily leveraged capital structure is very common in private equity-backed companies, with a number of implications that executives should take the time to understand. Active ownership. Private equity ownership is generally marked by heavy demands on all areas of a business, though the value creation potential of the private equity model remains compelling. I'm David Johnson with Abraxas Group. Thank you for your time.